So my mum's a teacher, my dad's an electrician. They bought their house at 23. And let's be real, like it's still as hard as it ever has been to get on the property ladder. But then if you look at the market in 2026, I think it's potentially quite a good year.
Eddie Ross is co-founder of mortgage broker Tembo Money, which he built to help first-time buyers get on the ladder.
They don't understand their affordability early enough. So that's one of the first mistakes. Everyone gets told 4 to 4.5 times your borrowing, right? But in reality, there are a lot of options. Have you come across the first home scheme that nobody talks about?
Do you think that people should even be asking, is this a good investment?
So that's the most important thing. Like, is buying a home right for you and for your plans?
So Eddie, it always feels like nowadays, it always feels like this. It's bad news for first-time buyers. It's not easy to get on the property market, get on the ladder. Do you have any good news for us?
I do. I think I do have good news. Look, I think let's be real. Like it's still as hard as it ever has been to get on the property ladder. We've seen sort of household borrowing still at 9 times borrowing for the average property price. But then if you look at the market in 2026, I think if you're looking at buying your first home, I think it's potentially quite a good year. So what have you got to think about when you're potentially buying your first home? You look at house prices. So what does the market look like? Is it a really hot market or is it a down market? Over the last 3 or 4 years, I think, especially over COVID, we saw like double-digit property price growth. We saw way more house buyers than house sellers. So when you went to view that property, there were 4 people turning up for the viewings, and you had to buy it within like a week of viewing it.
Full and final on day one.
Full and final on day one.
All that nonsense.
Yeah, sealed bids, quite aggressive. Definitely a seller's market. I think now in 2026, the landscape is quite different. There are, it's predicted to be between like 1% and 3% house price growth this year. And what that really means is that the market has sort of reached parity between the number of buyers and the number of sellers, which means that when you go and view that property, you're not going to be put under loads of pressure, and you're going to have time to sort of think about, is this the right property for me? So that's great news. I think another piece of good news is mortgage rates. So they're not at the low of like COVID where we were like sub 2%, but we're not at the high of the last 3 years ago, 2 years ago, where mortgage rates were 5%. So if I'm a prospective first-time buyer, I'm not overpaying for my mortgage right now. That's a great sign. And then finally, I guess we've got to look at affordability. So what does the landscape look like for a first-time buyer who's looking to buy their first home from an affordability perspective? And it's still extremely tough. Like that's the reality for most buyers who are looking at buying. They're still 9 times. The average is 9 times your income. The average is 15 to 20% deposit. But for me, there's some good things that I'm seeing in the mortgage lender space in terms of product innovation to help sort of unlock those buyers that potentially can't get on the property ladder themselves without a bit of support, which I can definitely talk about.
We'll get onto those, yeah.
Yeah.
I think the message is it's easier, it's still not easy though, right?
I think that's exactly, you said it much more succinctly.
No, it's fine. I mean, it's a hard thing when you look at the data because you basically, I made a video on property market the other day and it was like, the affordability is easier than it's been in the last 10 years. People's wages are growing in inflation adjusted terms, like for the first time basically since 2008.
Yeah.
But the deposit requirements are still massive because the valuations are high.
Right.
And I think, if it was impossible for you 10 years ago, it's probably still going to be really hard today. It's not like suddenly, I can go out and buy what I want.
Yeah. Yeah. And when you look at the data, because everybody talks about sort of 5% deposit mortgages as a real enabler, and they are for some areas. I think a 5% deposit mortgage in London is almost untenable because you need to fill that gap with your borrowing, right? And your borrowing is at 4.5, 5.5 times your income at max. So actually, when you look at the data, the average deposit for a first-time buyer is between 15 and 20% of the property.
When you said that, I was a bit shocked because I thought it was around 5 to 10%. So I was like, okay, I just need to save 10% and then I can get my property. But why is it 15 to 20?
Because they won't get the borrowing.
That's right.
Because if the house is 700 grand, they're going to need a massive income to be out 4 times that. So you divide the 700 by, do you know what I mean?
Yeah.
It's almost funny that the lowest deposit mortgages are suitable for the highest paid people who have the most affordability to save up a big deposit, if that makes sense, because you need a huge income to justify the mortgage.
Completely. It is, I would say it's very sort of like market specific. And what I mean by that is London versus the Northeast. There are areas in the Northeast where those low deposits, so we've seen a 0% deposit mortgage, and we've seen a 2% deposit mortgage come out quite recently. And then we had the 5% deposit scheme that the government ran. Those mortgages are useful for those areas. We do see propensity in those areas for those types of mortgages. But as I said, London and the Southeast in particular, we see almost zero of those mortgages because, as you said, Damien, those buyers just don't have the borrowing power that they need.
But I think it doesn't make sense because if you can afford the mortgage, like a lot of the time, Damien's video said that people's mortgages are probably lower than their rent. So you can afford to pay the monthly installments. Why do you need so much money? If you can sort out the deposit and you can pay the monthly payments, why do you need 4 times your earning to be able to get a mortgage?
Yeah, why do you need 4 times earning? So there's lots of complexity in what mortgage lenders can do in terms of how much they can lend you. Fundamentally, the ruling has been since the property market crash that they have to, on average, lend at 4.5 times your income across their portfolio. And it used to be that 15% of their portfolio could be lent on average above that rate, right? So that's quite complex stuff. They recently removed that because they saw that actually that was overbearing and unnecessary. And the reason they removed it is because the other control they have is around stress testing. So the reason you're limited at 4.5 times your income sometimes, not always, is that you also have to prove that you can borrow that amount at a much higher rate. So a lender will stress test your mortgage at perhaps say 8% in case the mortgage rates went up, and can you still afford it? So those protections against how much you can afford are usually there. That they're no longer 4.5 times your income mandated, but they end up being around that because of the stress testing rules.
I think they broadly worked as well. So if you look at the change that we've just had, where we've gone from near zero and everyone was getting really cheap mortgages, there was this big move upwards to say 5%, 6% maybe even at the worst, the Liz Truss moment.
Yeah.
And
that was a bad time for us.
there was, I can imagine, mate. Yeah. There was so many people saying, it's going to be like 1991, 92, repossessions everywhere. And we just didn't see that in mass. Mate, there has been, clearly there will have been a spike, but it almost seems like the stress test worked.
Yeah.
You know, they protected the broader market.
Yes. I mean, it does work. And so like the larger lenders in particular, they're I guess more, they don't have much freedom when it comes to sort of innovation in their products from an affordability perspective. So like niche building societies, for example, because they don't lend as much money, they have weirdly more flexibility on their loan to income ratios, which is why when you see, and we should, hopefully get onto this topic, some of the product innovation in mortgages, sometimes it's the lesser known building societies that can sort of maybe maximize your income 5.5 times, 6 times your income. And might be from Principalities Building Society that nobody's ever heard of,
So I saw it was like Skipton at one point were advertising 100% mortgage.
Uh-huh.
I did a video on it at the time and I looked at it and the terms were quite tight. So that it almost seemed like a way to just grab attention for their products rather than actually a useful product that people could get.
Yeah. So we've done about 45 track record mortgages.
Are these? Can you explain what that means? Yeah.
What's a track record mortgage?
Okay. A track record mortgage is exactly the product that you're describing. So 100% mortgage offered by Skipton. what that means is that you borrow 100% of the property price. So if your property price is 250,000, your borrowing is 250,000. And it doesn't really work because, as you said, the criteria for that mortgage is incredibly restrictive to higher income, best credit borrowers, which don't really align with 0% deposit mortgages, because usually those that are higher earners with better credit would tend to have a bigger deposit. So it was a little bit of a marketing stunt. I do support their innovation, though. I do think it's important that that the lenders are pushed to innovate in this space and try and find ways to help like different segments of first-time buyers. But yeah, we haven't done a load of the Skipton mortgages, the track record mortgages, just because of the criteria restrictions.
How many mortgages so that 45 number, how many mortgages would you have done total over that period, so we get an idea of like the scale?
Over that period, we'll have done about 25,000.
All right, so yeah.
Very small. Drop in the ocean.
Yeah. So, okay, I want to play like a devil's advocate here around these kind of products and ask, how good are these products for the individual and for the overall market? Are there certain people that, is getting the deposit requirement a requirement because it shows that you have an ability to save, it gives you some skin in the game? Should we be giving people 100% mortgages? It feels like a bit, like The Big Short, 2008. The strippers buying all the condos, and they were like, "Oh, no money down." It's got that vibe to it.
No, for sure. So, I think in reality, lenders know that. So they have got a lot better at underwriting credit risk, right, on mortgages. Hopefully, because of the 2008 thing. So they have learned the lesson. As we've talked about, we've seen regulation protect a lot of the potential lending that shouldn't have happened previously. So I think, your question, is it good for the market? I think because the underwriting criteria and the protections are still in place from a stress testing perspective in particular, then yeah, it is good for the market, because it really just isolates those that are almost certainly going to pay back that mortgage. But the downside is there's just not many of them. Like, there's just not many products that are getting sold.
Because then once you get to 100%, they're going to be like, well, you need a good credit rating and you need a really high income. So you're like a rare kind of person that owns loads of money, is really good with their credit rating, but doesn't have a deposit.
Exactly. Now there are other like products that 0% mortgages, deposit mortgage is probably not a good example, and the 2% deposit mortgage is probably not a good example. And as we've discussed, like if you get a 2% deposit mortgage, you have to fill the 98% with borrowing, and most people who would need a 2% deposit mortgage can't get that amount of borrowing. But there are other products that are out there to sort of help different segments of first-time buyers. For example, I was listening to a call recently, because I like to sort of listen to keep my ear to the ground on what our customers' problems are. And it was a lady who worked for the NHS. And she initially came in as I'm looking to buy within 18 to 24 months. And she spoke to us, and actually when you look at, there's a lot of options there's actually, it's not widely known, but there are certain lenders that will like extend or improve their LTIs for different segments.
Sorry, what's an LTI?
LTI. See, I'm just in the mortgage world.
You're in deep, mate.
I'm in deep.
I'm just looking in, like, what's going on here?
Sorry. Yeah. So loan to income. So 4.5 times your borrowing. Everyone gets told 4 to 4.5 times your borrowing, right? But in reality, there are a lot of options which you can extend to 5.5 times, right? So there are some really good lenders that, for this lady, for example, would lend her 5.5 times her income, because from their perspective, NHS and blue light workers, they're actually really like strong, stable.
They got a job for life.
Exactly. So we managed to sort of enable that, enable her to buy sooner. They're the best moments for us when we speak to customers and they think they're miles away from buying a home, but actually they speak to us and they're like, actually, there's an option for you where you might not have known about called the blue light mortgage. And another, sorry, go on. Yeah.
Is that the blue light mortgage? Is people in the end like the work for?
Yeah, so that's what we call it. That's our aggregation for all sort of what they call it, key worker schemes. So Kensington, it's called the key worker scheme. Kensington, really good lender for first-time buyers. We've seen quite a lot of innovation from them.
So is that NHS people, council,
police,
people that work for the council, police, like stable jobs that kind of ratchet up in every couple of years, you get a bit more money, yeah?
Exactly. The complexity on the NHS side sometimes comes with like bonuses and overtime. But because that's a well-known thing in the market, lenders have become much better at understanding like true affordability when it comes to sort of non-committed, non-contractual overtime. And you usually get that factored into your basic salary as well. So yeah, my message for that is, if you think you can't afford it, don't just use a calculator that does 4.5 times your income. Like, actually try and speak to a mortgage broker and get a true understanding of your affordability to get that benchmark before then you look elsewhere. Yeah.
What other products are there then, while we're on this thread, that some of the...
Yeah, there's so many. So self-employed.
Hello.
Self-employed.
Talk to me. Talk dirty to me. Let's go.
So...
barely employed. No, honestly, he's everything to every man. This whatever you need, import, export,
bit of this, a bit of that.
Self-employed, yeah. So there are massively misunderstood myths about self-employment mortgages. So the first one is you need 2 years self-employment history to get a mortgage. Not true. We recently did a mortgage for a chap who was 6 months into self-employment, but before that could demonstrate permanent employment instability. And because of that, the lender was happy to accept that 6 months of self-employment history because he'd been working in that sector and could prove that he had a stable income. So self-employed schemes, there are certain lenders that are really good at maximizing borrowing for self-employed. And there are also some that aren't very good. So that's where the myth comes from, because what a lender wants to see, ideally, is that you've got 2 years of self-employment earnings. We'll take an average of those, or some of them will take the lowest of those, or some of them will take the most recent of those. There's actually lots of different ways that they might underwrite that mortgage. So self-employment's one of them. Something that we haven't really touched on yet, and actually where Tembo's roots began, is in family-supported mortgages.
I've got a family.
You've got a family, yeah.
They support him a lot as well.
So around 40% of purchases for first-time buyers have some involvement from the bank of mum and dad, right? I think that's pretty obvious. But that usually comes in the form of a gifted deposit. Now, there are lots of other schemes, actually. So one of the schemes that is a really good one is called, we call it Savings as Security, which Barclays call it Barclays Springboard. So what happens is, if you're struggling to save a deposit, you can get a family member to put that deposit in a savings account with Barclays, and then that acts as securitization for that deposit, right? So you don't actually, let's say my mum, she puts £30,000 in a Barclays Springboard account, and she earns interest on that, but at the same time that acts as the security deposit for my mortgage. Right.
That's cool. So did the mom in that example keep ownership of that money?
Yes.
It's her money.
And she earns interest on it.
This is great, because this is like the kind of thing I'm worried about. You know, in a decade or so, buy my son a house, it's his, and then he like sells it, and do you know what I mean? Like, yeah. or like meets the love of his life, and then they get divorced after 6 months and it's gone. You know, I like the kind of... And it also is not like, here's your money now, it's a gift. It's like, oh no, I'll help you, but you've got to kind of...
So they kind of keep it escrow, and then in what case would that money be taken out of the Barclays account?
Yeah, so
you meant to pay it off as the owner. So if my mum puts 30K, I meant to pay it off slowly, or how does it work?
So when it comes to remortgaging, so those products all come with a minimum 5-year fixed term. What's a 5-year fixed term? So when you take a mortgage, there's so much complexity when there doesn't need to be, but when you take a mortgage, you fix your rate for a period of time. If you plan to live in the property for 2 years or 5 years, so let's say 5 years in this example, then you would fix that for 5 years. And what that means is the interest rate stays the same for that first 5 years of the mortgage. But these products in particular, they all require a 5-year minimum fixed term. So they're not suitable. If you're looking at buying a house and you're thinking you might move in 2 or 3 years, it's probably not right for you. But if you're happy to stay for 5 years, then after that you would remortgage, and then it's up to you what you do. So if you've raised that deposit and you've got that money to pay back your parents, you can basically, they can take it out of that escrow account, and then you can put the deposit towards your mortgage. But hopefully by then you've got enough equity in it where you don't need to put any money down, and the equity in it is over 5%. That's the dream scenario.
And if they meet that, would the Barclays in that example or the mortgage provider say, okay, you can take the money out now because your son, daughter is at the minimum requirements of equity?
That's right.
Okay.
Yeah.
It's pretty cool.
Yeah. So that's a really good one. Then we get into the mortgage jargon ones. So if you think I've been talking mortgage jargon, how about this for a scheme? So joint borrower, sole proprietor mortgage, right?
Yeah.
So we call it the income boost. So what does the income boost do? So if I'm a prospective first-time buyer, and let's say I've got £40,000 of salary, and I need to get to 60,000 to borrow the amount I need to get onto the property ladder. Lenders have brought these products out where I can use my family members and sometimes even friend or extended family's income on that mortgage and combine it. So I can combine my borrowing power with my mum.
Or with Damien.
Or with Damien. if we want.
Good lad. He's a good friend.
And so that's the joint borrower bit. So my mum would be my joint borrower in that scenario. The sole proprietor bit is I'm the only owner. Right, so she joins me on my mortgage, boosts my borrowing power, but doesn't own the property, and is optional whether she contributes to the mortgage payments. What I would say about those mortgages is you usually treat them as a bit of a stopgap. So they're like a leg up to get on the property ladder, and then after that period of time, maybe the first 5 years again. When it comes to remortgaging, you can take your family member off the mortgage then, and they don't need to be there. And a crucial part as well is obviously, my mum, she bought her house in Leeds for £80,000. So she's not a first time buyer, but if I'm a first time buyer, I still get my first time buyer status, even though my mum's joined me on the mortgage because she doesn't own the property. That's a key point because obviously the stamp duty relief and things. And on the joint borrower sole proprietor piece, it is worth mentioning a bit of a warning for whoever's going to be your joint borrower. They are also liable for that mortgage, right? So if you can't make your payments, they are guaranteeing effectively that they'll make the payment for you. So whilst you're using maybe a partial amount of their income, if in the worst case scenario you couldn't afford to pay off the mortgage, they would also default on the mortgage too. So there is that aspect to look at as well.
If you're a small business owner, freelancer, or sole trader, then I want to tell you about one of my favourite finance tools in the world, Xero. It's accountancy software and we use it across all of my businesses. So this podcast, my channel, and the newsletter. Xero's great because it makes accounting as easy as it can be, and I say that confidently because of my mom. I wanted to get her involved in my business to help with bookkeeping and accountancy tasks like creating invoices and filing receipts. And she said she would do it, but only if we use Xero because she had experience with it from her previous business and absolutely loves it. Your tax returns can be filed directly from within Xero as well, which is especially important with the changes to making tax digital. But what I like most is how easy it is to see what's going on across my businesses. Revenue, profit, cash flow, all the stuff that I need to be on top of. So if you're looking for accountancy software, you should 100% check out Xero. You can get 90% off for 6 months by going to xero.com/makingmoneypodcast. There's a link in the description for you as well and a QR code on screen.
Are these new products or have they been around for a while? Like that one sounds really interesting. I mean, they all sound really interesting. So I'm feeling more optimistic already. I want them all. Can I get a bit of this, a bit of that? Are they all quite new?
They are. So guarantor mortgages have been out for ages. Like, years and years, but these are the modern day guarantor mortgage. So they've been out, I think 10 to 15 years now. But really the problem with these mortgages, and this is what we do at Tembo, is we try and sort of demystify joint borrower sole proprietor, and we call it income boost. So these products have just been under distributed because nobody understands them. Even brokers don't understand them. So now with the affordability challenges that we're seeing, these products are now getting the airtime. In fact, it was Nationwide, I believe, it might be NatWest, that just launched their joint borrower sole proprietor and called it the family-backed mortgage, literally like 3 months ago. So this is like an innovative space. New products keep coming out. And I think they're wicked products because they're like a leg up on the property ladder. You know, support from your banker, mum and dad, is almost mandatory these days anyway. And this is just another way, rather than being a gifted deposit, it's sort of like gifted income for a bit.
You say it's almost mandatory. Do you despair that about the solution is basically more complicated products, more ways to fill the borrowing problem or the affordability problem rather than more houses being built, say?
No, I do. Like, as I said, it was very different 30 to 40 years ago. My mum and dad. So my mum's a teacher, my dad's an electrician. They bought their house at 23, no problems with affordability. That has accumulated in value, maybe worth 4 or 5 times what they bought it for. So now we've got a property market that, over 70% of the property in the UK is owned by people over 55, right? And the previous generation, to me, has all this asset wealth, and it's not liquid wealth. My mum's not doing anything with that money, but as a result, so she's asset rich. But then the next generation have this big problem of, how do I buy a house now then? So we look at it from a generational wealth perspective. How do we pass wealth between generations in an effective way so we can solve the problems with the mortgage market?
I also like how these solutions, especially the one where you put the money in the bank account and that, it can rely on the wealth of the generation above without actually them giving up their wealth.
Yeah.
Right.
So because I think for a lot of people, there's this pressure. It's like, oh, mom, you did all right. You got this house. And now it's like, yeah, but I have one house. I live in it. And if I sell this house, I have no house.
Yeah.
Right. I'm like, it's binary, and most people don't, just because you've got £1 million house in central London doesn't mean you've got £1 million in the bank account necessarily to just give over.
Exactly.
But you might have that kind of flexibility to go, well, I can put you in stewardship of that through a banking arrangement, and then I can take that back and I can live off it in my retirement. It seems to solve a problem there, that there's like a conflict.
Yeah, and there are even products where, and this is obviously, I will caveat this with it's only right if you're comfortable with what's happening. But that example there, where my mum's got that wealth tied up in her property, she could actually release some of that wealth and gift it to me as a deposit. Now
She's got to pay off the mortgage.
Then she's got to pay off. But we have seen, so we call it our deposit boost scheme. And what we see people do is take and this is quite technical now. So because my mum's a bit older, she'll take what's called a retirement interest only mortgage. And you can think of them as a ethical equity release. So equity release, everyone's alarm bells ring in. I don't want to release equity in my property. I'll end up losing it. And the reason that is because you don't service that monthly payment. You don't service the interest and it accumulates. Retirement interest only mortgage, as their name suggests, means that you just pay off the interest. So the balance doesn't increase. So what you could do is you could take a 30 to 40K loan on a retirement interest only basis on a family property and use that towards your mortgage deposit. And we've seen home buyers do that, but also service their parents' loan.
I was going to say, put it on the kids.
Yeah.
So you've got to pay the debt.
Yeah, because when mortgage rates are quite low, and even it's a really good product when mortgage rates are 1.5%, because you could end up raising a £30,000 deposit with a £50 monthly payment, which is amazing.
Are these rates variable? Do they shift with the market?
So you can same like fixed. Yeah, you can get variable ones, but they're mostly fixed. Yeah.
For the lifetime of the loan, so like 30 years, or is it? It's almost like an annuity, right? It will just run until you die, and then at that point you pay the balance off. Is that
so? Usually, the repayment vehicle is that property. Yeah.
yeah? When the
they sell
person
it.
dies or sells,
Yeah. Well, that's actually not. Sorry, that's not necessarily true. So it depends on the balance size. So if it's a smaller amount, like 30 to 40,000, we've seen our home buyers just pay off that balance once they get that wealth over time. But sometimes it is they would repay that, at the end of the mortgage term, either when they die or they pass it to the next generation. But the mortgages in terms of like how long they're fixed for, it's just the same as the normal residential mortgage like landscape, 2 year, 5 year, and the full term runs until the end of, sometimes the end of life.
do you see any complexity arising within families because of these kind of arrangements and them going sour at all?
So it's very personal, I would say, as in it depends on your relationship with money, with your family. If you're regularly talking about money over the kitchen table, and you have that relationship, then you can do it informally. But there are sort of agreements that you can put in place to make sure that those awkward conversations don't need to happen about who owns what. And so, for example, if you wanted to, you could put in a agreement where if they give you £30,000 towards your property deposit, that they own proportionate amount of equity in that property. We do see that happen, particularly with friends. So we've helped friends buy together, and there's this wicked product by a lender called Generation Home where it's called dynamic home ownership or dynamic income boost, where you build up equity together in the property. So if you contributed £500 this month and you did 1,000, then you would buy like incremental shares of that home.
It's like a pot that like it tracks how much you've paid in.
Yeah.
So if one person wants to have like a better room in the house or something,
That's right.
they go, I'll pay a bit more and then you get more equity.
It's such a good product. It's just like, that's what you do when you rent, isn't it? Like someone pays a bit more because they get the best room.
Yeah, they got the better room or whatever.
You work with a lot of first-time buyers, so I can feel how I am compared to the rest of the country. What's the average age for first-time buyers in London and in the rest of the country? 'Cause I know it's different in London.
It's crazy. As I just said, my mum's 23. The average is about 34 nationally. And when you in London, it depends what you read, 37 to 38. Is the average first-time buyer.
It feels like that shot up in my lifetime as well.
Yeah.
Like I remember being younger and I feel like it was under 30, 27, 20, 28 when I was...
Even in London, it felt like 31, 32. A lot of my friends were getting on the
average as well. So,
property ladder, yeah.
An average is I don't know if it's a median or a mean, but it means a lot of people are way above that.
Yeah.
There'll be first-time buyers in their 50s, basically.
This guy.
To be honest, I rent at the moment. London is a very broad term. Like London, where we are here, nice residential, terrace house, very different to central 2-bed new build apartment. And I think this is actually one of the problems. Is first of all, I want to walk to work. My office is in London Bridge. What do? Do I buy a central apartment in London? I don't think so. First of all, they're nearly £1 million, so I can't afford it. Service charge is just ridiculous. So who's buying these properties? Like that? That's why the first time buyer age is going up in London, because if you work in the city, you don't want to. From my perspective, there's not a lot of desirable purchases that you want to make. So I completely understand the London thing, but then when you look at London from let's move slightly to the outskirts and buy somewhere that's commutable. That's where I think it makes more sensible, purchase decision, a more sensible purchase decision.
Yeah, Manchester's certainly moved to more like a London market, I would say. There's parts of Manchester now which I think are comparable to London in terms of a house like this in Hale is the exact same price, 800 grand, ish in Hale in Manchester. But I'm always conscious of when we focus on London, which Londoners tend to, 90% of the population live outside of it potentially, and the markets are very different, aren't they?
Yeah, they're completely different. As you said, so Cheshire, Hale, So I used to live around the area, and
gone crazy.
It's gone crazy. You've really got to look at just in the way that we segregate London's property market. There are individual sort of micro local markets within like counties, even cities, right? So, what I would say about London is the central market doesn't look like an amazing investment in my view. I'm not a financial advisor. You come wider outside and you look at properties like this. I think that's where the sensible money's going. And then when you look at the other markets, Manchester is, from not necessarily investment perspective, but in terms of previous performance in the last 10 to 15 years, Manchester's done really well. Like Manchester, Leeds, Liverpool, they've all done really well in terms of like capital appreciation and price, for those that managed to buy their home. But yeah, so what my advice is, I guess, is that when you generalize like Manchester, actually look at the markets in a closer detail and think, because you might surprise yourself that, as you said, Damien, like a property here might be 500,000, and then a couple of neighbourhoods over it might be 300,000. So
look a mile from where you want to buy.
Yeah,
basically, and that's the market. Yeah. Because you could be. So I don't want to bore people with Northwest geography, but you could be in Hale, and in 20 minutes you're in Wigan. And Wigan, like a terrace house in Wigan, you could get for 100 grand potentially,
right.
Whereas in Hale it's 700.
Right.
So and people go, oh, the Northwest. And it's not the same.
Yeah.
It's not the same. I'd want to come back on something there. You talked about investment, right? Do Tembo focus on home buyers as owners, or do they focus on the buy-to-let market?
No, owners.
So really, how do you view it as an investment piece at all? Do you think that people should even be asking, is this a good investment, or is this?
Yeah, I do. Yeah, I think, buying a home is first and foremost the emotional connection of like buying something that you own, maybe to potentially raise a family. So home ownership is just like a fairly innate trait, isn't it? In UK, people just feel like they want to buy their home. So that's the most important thing. Like, is buying a home right for you, and for your plans, and certainly the short-term plans like 2, 3, 4, 5 years. If you're not sure, potentially don't buy. Take my situation right now. I'm not buying in London because I'm not sure what's going to happen with the property price market in central London. Plus, I can't afford it. Right? I'm a startup founder. Don't do it for the money. So what am I thinking about London? I'm not going to buy it because I'm not. If it was Manchester or maybe potentially like more outside of central London, that's when I'm thinking this is a better investment for my situation.
Yeah, I mean, the one thing is though, it's a home, right? It's a place to live in, and it's like an essential need. And I think if you're viewing homes from the perspective of investments, I would say there's better investments.
Yeah,
like the stock market is probably a better investment. The one thing that the housing has is the leverage component, right? Which is what makes it attractive typically. But I worry about people that go around going, oh, is this house that I really want actually a good investment? Because it's like, well, where else are you going to live? And the alternative is renting. Have you looked at if that is sensible versus ownership?
Yeah, we have. We actually did some research. So the reason why I think about investment or like commercial comparison is when you look at homeowners over a 20-year period versus renters, a homeowner is about 200 to 250,000 pound better off over that period, just because they own their home.
Assuming they live in the home.
Assuming they live in the home, and that, by the way, isn't including capital appreciation. That is literally just
that rent
buying.
Oh, yeah, and does that what does that assume that the renter does with the money that they've not put down as a deposit? Say,
yeah. So it's
what I mean?
Yeah. So let's say they've got 30,000, 40,000 in their deposit. That might appreciate 6% over the term, but the maths are still way in favour of the homeowner, because you're buying that leverage effect, you're buying that capital in that property over time, and rather than servicing your landlord's mortgage, you're buying a thing that's your own. So yeah, fair point. You've got to think about the opportunity cost of where you put that deposit.
You could have invested it in the stock market in an ISA,
Yeah,
tax-free gain.
yeah, but
You've also got repairs on the house. You factored that kind of stuff in, like the maintenance cost, and
you've got more ownership costs for sure. But when you do the maths, home ownership is a big deal. Like it's between 200 and 250,000 versus
In a decade.
renting.
over
versus
10 years.
Over 20 years.
Over
sorry.
20 years.
Yeah.
And just through the function of rent is dead money, in quotation marks for the people listening at home. I don't necessarily believe that. Versus you build an equity position within a house, and that's the difference that you see there.
That's the difference, yeah.
So T, in your opinion, what makes a good salesperson?
Me, resilience, a sense of humor, empathy, a dogged determination. You just can't give up.
Yeah, the ability to take no.
Yeah, and just keep going.
I think the one thing that does block a good salesperson, though, is compliance.
Nightmare.
This is why we're happy to be working with Vanta. Vanta automates compliance with security protocols like GDPR, HIPAA, ISO 27001, and SOC 2.
If you want to do business with larger companies or grow internationally, then you need to prove your compliance with these kind of standards, or your deals will get blocked.
Compliance is one of those things you just have to do in business. And the beauty of Vanta is they make it really easy, saving you up to 90% of the time it takes to prove that you're compliant. And on average, $500,000.
So if you know what those acronyms are, then you probably need Vanta. You can get started at vanta.com/making money. That's VANTA.com/making money. There's a link in the description, and we've put a QR code on the screen.
But again, what I want to come back to is the reason to rent and buy is not an investment decision. It's a flexibility, lifestyle, and kind of where I want to be in the world decision, right? I don't go to Bali on holiday for like 2 weeks and go, God, if I bought this place, no. I would be better off than just renting it for the 2 weeks. It's a lifestyle point, right?
Of course it is. That's my point at the start. Number one is, does your lifestyle suit home ownership? Mm-hmm. Like, am I going to move? Like, for me, am I going to move? Do I want to live in the same place for 5 years in central London? Probably not. So it doesn't make any sense for me from a lifestyle perspective at the moment to buy my house. So you've really got to think, if you're thinking about buying your first home, what's my plan for the next 5 years? Mm-hmm. Am I happy being in this same place for the first 5 years? And I say 5 years because 2 years, by the time you've bought the property, you've paid for the cost, the stamp duty, all the costs involved, 2 years, you're not going to be, if you're looking at a financial perspective in the comparison we just said, you're probably going to be neutral, right? In terms of renting versus owning a home. And by that point, you may as well just rented, solved all, not have any of the hassle of buying that house and had the flexibility. So you've got to look at your own situation. And one of the good things that's happened in the UK is becoming a landlord is not a great.
It's not as profitable.
It's not a great prospect. I won't go into too much details about first time buyers, but unless you own a portfolio of companies, buying a property to let out that you don't live in is almost pointless now. And you are definitely, can't say that I'm not a financial advisor, but you're almost definitely better just sticking it in an ISA at this point. Unless you set up a company that does buy-to-lets. But then you really do struggle with mortgage lenders. You can find them, but you're probably paying 2% more than the average 2-year fixed for that. So
yeah, I am. So I have a group company structure,
right?
And there's profits within the business, and I wanted a bit of diversification. So I got buy-to-let, and like you say, the lenders are few and far between. The fees,
exactly.
Oh my God, the fees, mate! You're talking like 5-6 grand on a mortgage fee on a house that's 150-60 grand,
wild.
Plus the stamp duty of the extra stamp duty of 8 grand. So you're talking 10% in fees of I call tax a fee, in that sense, just to get into there.
It's definitely, you lose your first time buyer status, so you lose the stamp duty relief. So that's 300,000. So stamp duty for the audience, just property tax when you buy your house. First time buyers get a relief up to £300,000. And then between £300,000 and £500,000 property value, you pay 2%. if as a first-time buyer, this is another thing that's changed. If as a first-time buyer you buy a house over that 500,000, you don't get any relief. So if you buy a property that's 501,000, you lose all the free relief up to like 300. So you start paying normal stamp duty. So
Pretty tough in London. Then.
yeah. So I guess my point is like property values below 500k are much more desirable for first-time buyers than over 500k because of the stamp duty stuff. Yeah. But another thing about the landlord situation is that's good news for first-time buyers, because that's one of the reasons that supply and demand is reaching parity. So you've got landlords that are like, what is the point in this? I'm just going to sell it, which is great.
They're exiting.
That's what we wanted.
Yeah, great.
That's well done, government. We don't say that a lot, but like that policy is working. Where we're taking houses off landlords and we're giving them to first-time buyers. Mm-hmm. Amazing.
Yeah. It'd be good if they just built some more houses as well.
That'd be helpful.
Because one thing you will say is the rental market on the other side there's less choice on the rental market.
Yeah.
I look at the rental market in certain areas now. I put my house up. I'm the only house in that area for rent. Yeah. Like, what does that mean I can do in terms of rent if I wanted to? If I was unscrupulous, I'd be like 10, 15 people apply within a few hours. You know what I mean? Like, they're bringing in the Renters' Rights Bill to stop all the bidding wars and all of this stuff. But the exiting landlords is great for first-time buyers, really bad for renters, potentially, if there's not supply there.
Yeah. The supply of homes conversation, I think it's 1.5 million, the target.
Yeah, dreaming.
I think it looks like, so it looks like we'll be about 800, 900,000 versus the 1.5 million target, right? So where there's a shortfall of house building, and we need to keep that policy front and center. Like, we need to encourage more house building to increase the supply, to keep the market like not overheated, basically.
And it feels like it should be social housing, so that the government has some control over rental prices.
Exactly.
If you whack up a load of social housing in an area, you can influence the prices in that area, right?
Right.
So, and it feels like that would help the market a bit.
Definitely. And actually, when you're a property developer now, so one of the reasons that there isn't as much supply is you've got to make it attractive for property developers, which have not had a great time in the last 10 years. And one of the things they've got to do, which is great, is if you build new houses over maybe more than 50 houses in one place, you have to have a portion of them of social and affordable housing, which is great. That means that new build housing developments that go up, that X% of them will be available on either a shared ownership scheme, on the first home scheme, or like a potentially a discount marketed like value, which is incentivized by the developer. But I don't know if you come across the first home scheme that nobody talks about.
No.
Yeah, so nobody really talks about the first home scheme, and it's not a big volume play like for us either, but it's actually quite good. So the first home scheme means that when those property developers build those houses, that they sell a portion of those houses on the first home scheme at a discount to the market value. And that discount can be up to 50% of the property value. So you're buying a home for 50% less than it's worth, and the developer funds that. Right? Sounds amazing, right? But the downside is when you sell it, you've got to sell it to first-time buyers and also discount the market value by the same rate. So we haven't seen a lot, because the reason we haven't seen traction is because there's just not that many property developers building those first home schemes. But my advice is have a look at first home scheme. It might be right for you. It might be a less risky way for you to get your foot onto the property ladder.
I love a discount. I love a sale. How does it work as a first-time buyer? Do you also have to sell it as a 50%? So say the house is, for simple maths, 200k, you buy it for 100k, and then you keep it for like 40 years and you want to sell it. Do you have to, obviously the price goes from 200k to maybe 250k. Do you then have to sell it at 125k?
That's right. Yeah.
So, okay.
That's right. You get an independent valuation and they say it's worth this much, and whatever you sell it for,
So where's the other 50% of the value go?
Yeah, well, the property developer pays for it at the point when they sell the first house.
What's the incentive for them to do that?
They have to. As in, like the affordable housing thing, they have to they have to meet their affordable housing targets. So they can either do it on first home scheme or shared ownership. And shared ownership is often very different, as in it requires a housing association setup. So you'll end up seeing first home schemes pop up where there's new build developments.
Can developers actually make money with these conditions? I looked at, because one thing that surprised me, and I don't know if I might just be misreading this situation, but we insure the house that I bought for more than the value of the house.
Right.
So the house was 150, but the insurance was 200 grand. And I was like, is this house cost more to build than it's worth? Is that what's going on there? Because if that's the case, how are they ever going to build houses?
Yeah, it is definitely. Property developments, new build property developments are very profitable for the property.
They do make a lot of money.
They make a lot of money.
Flying up then.
They make a lot of money, but it takes a long time for them. One of the reasons we've not hit the targets, it takes a long time for them to sort it out. Like planning takes ages for them. You've got to select the right development. You've got to get approval. Because you've got to make it worth it for them. So I don't know if you've seen, but it's quite often that if it's like a number of new build houses, they'll either go really small to not have to do the affordable housing thing, or they'll go massive and like 500 properties. So it's quite interesting. Like when you look at, they built like 49 houses, and you're like, because you didn't want to build any affordable houses,
Is this nationwide or?
I think it is nationwide. I think I've not seen it. We have not seen many first home schemes.
Can you give me one if you find one?
Yeah, that's what I mean. Where are they?
But is that forever? So everyone who ever buys that home has to take that discount, even like 6 generations down? Because you get this thing in like 400 years where people are like, what do you mean I got to knock 50% off the price? What's going on? August Tremaine did a deal. Like,
We'll talk after this.
Yeah, like,
it's forever.
Does it not just so... what's that going to do to the value of those kind of units? It's like the shared ownership thing. I think people get stuck in them, or they're not very attractive to.
Shared ownership is quite it's fascinating if you're a mortgage nerd like me, but it is a fascinating area, and it is exactly the same thing. Resaleability of shared ownership is just lower. There's more conditions. There's more things people have got to think about. You have to get the housing association's approval. There's a lot of stuff flying around, like housing association. What's that? What is it? Well, basically, they're not-for-profit organisations that work with the property developer to say, right, we're gonna make a portion of this shared ownership or all of it, and we're going to own the share of the property that the buyer doesn't own, and they're going to pay us rent. Mm-hmm. So they've got this dual sort of authority of they're the landlord of that property, but they're also sort of sorting everything out. So prospective tenants is a weird word because you kind of own the property, but they're seen as tenants until you own all of the property. Don't know whether to go to the building manager, the housing association. Sometimes they're different people. So they end up in this situation where service charges, for example, one of the biggest criticisms with shared ownership is uncontrollable service charges because they're not regulated. Sorry, they are regulated. They have to be reasonable. That's the regulation.
Oh.
What does that mean? Whereas ground rent, I'm sure you've seen, like ground rent, that is actually now regulated. You can't
double it every 10 years.
Exactly. You can't do that anymore. So shared ownership, it serves a purpose. I think I'm probably on the negative side of shared ownership in terms of like, would I ever buy a shared ownership house? Wouldn't say no, but pick the right development.
People just don't know how to do that though. Do you know what I mean? And this service charge on houses is kind of, it's an odd thing, isn't it? Someone comes around every 6 months to mow the tarmac and trim the bricks. Just trimming your bricks, mate. 600 quid a week, that. Like, what are they doing? Do you know what I mean? Do they mow your grass for you? And I don't know. It's just it's an odd thing, isn't it?
They fix the lift, 20K.
But this is in flats. I was talking about the housing developments because I think again it comes back to if you're going to jump into these things where they're like give discounts or shared ownership, is it like, are you buying the property for the right reasons? Are you just desperate to say I own a home? And the good thing with the 50% off ones that you were talking about before, up to, if this is your forever home, who cares?
Right.
If you're like, I'm never leaving,
Right.
so I just get to own a home at a discount and pay this thing down really quickly and not be unencumbered, great. But if you're planning to like sell on, you might have some difficulties and be a bit trapped in that thing.
It's true. Yeah.
Yeah, we got some comments from people that were listening. So do you want to read out Marky B 444?
Marky B.
Mark B.
Mark B. I prefer Marky B. Like Marky Mark. I'm in my late 40s and grew up with...
Showing your age there, mate.
What, Marky Mark?
Back when Mark Wahlberg was Marky Mark.
This is how we used to get the party started.
Yeah.
We used to... Anyway.
Mixing the Bacardi, dark.
There you go.
Yeah.
Good Eminem lyrics right there for all you young people. I'm in my late 40s, I'm not, and grew up with it ingrained in me that you buy your own house. If I had my time again, I would rent until I had a family, just like me. All the financial models I've looked at say ownership makes no sense. Mortgages and student loan debt are a different level of debt versus earnings now, plus declining job market, etc.
Wow.
It's not really a question. It's more just
It's
like
more of a statement. Rant. Just the state of the country.
Wow.
Yeah, very strong opinions there. But yeah, all the financial models I've looked at say ownership makes no sense. I don't know.
I would rent until I had a family. Again, it's that thing.
Damn.
Affordability improves loads once you've got a couple, right?
Yeah.
And should you sweat yourself?
I think that's a fair viewpoint. It sort of ties into my, unless you're staying there for 5 years kind of thing. If you're not got a family and you're looking for sort of social mobility, or you might want to work somewhere else, like, you know, I think I subscribe to that. Probably disagree with Mark on the did he say the financial models don't make sense?
Yeah, ownership makes no sense.
Yeah.
Yeah, I'm not sure about that.
I'm not sure about the model there.
Let's see your model, Mark.
Yeah, sure.
show us how you worked it out. Let's see your working and your calculations.
Same with the model, I think. Yeah, but
mortgages and student loan debt are a different level of debt versus earnings now.
Yeah, student loans,
9% tax, the graduate tax. I mean, they're getting a lot of airtime at the minute, aren't they?
Shocking.
Yeah.
Declining job market, he said, but are wages rising now?
But there's more youth unemployment, right? So it's a weird job market in that sense. There has been real wage growth. I don't know how long that will continue for. And I think it's always weird to say, oh, you're getting paid more, because there's been a long period of stagnant, declining wage growth. Up. So, you know, it's improved. Again, it's easier, not easy. Yeah. And there's lots of people out, there's lots of areas of the job market that I don't think are doing that well. We've got one here from... Thanks anyway, Mark. We appreciate it, mate. We've got one here, number 7. So, do you want to read that out, mate? Does it said who?
Andrea, what ratio of your take-home income should your mortgage be?
Great question. It depends. You know, politicians answer. If 30% is what you'll probably be told as a default of your take-home income should be your mortgage or rent payment, right?
The net amount. So your net after tax income, whatever hits your bank account, 30% of that.
That's right. And so that's probably, I wouldn't say it's the average. It's actually probably slightly higher the average, but that's what you'll get told as the most sensible amount. If you don't have a family, because this is all about disposable income, right? And not being over leveraged or like overexposed to like paying off your mortgage and not being able to afford the things that you need to live. If you don't have any dependents, right, you could stretch to 40, depending on your lifestyle. You know, my take home, my rent's 40% of my take home. I don't have any kids. So 40%, anything above 40%, you start to question like that
your existence.
Yeah.
Why am I doing this?
House? Stupid house.
You're like 50% just goes straight out of the bank account every month. But
just on the mortgage. No, they got council tax and all that, so you're going to be
exactly.
60-70% in the hole.
So it's because you're protecting against the what if scenarios, really. Like, what happens if I lose my job? What happens if my mortgage rates change? So 30% is I guess is the short answer.
I think it's priorities again as well, isn't it? You know, I know some people that never want to leave the house, like in a nice way. You know, they're like, no, I'm not even bothered about going on holiday. I just like being at home. So you might go, well, I'll pay 40%, 45% for that
Right.
to have them in a nicer place. But if you're the kind of person that, like T, you want to go on holiday six
Every
times
month,
a year.
Nice.
Yeah.
Business trips. Mix a bit of business with a bit of pleasure. That's it. Yeah. Paid by the company. I like it.
Yeah. On record, mate, is wild.
On
Just
record.
to say that on record. We're one of the biggest finance podcasts in the UK, and you're there just like, a little bit of tax dodging. A little business, little pleasure. Your missus and the tax man.
Let's cut that out, guys.
No, leaving
my
that
boss
in.
is like, what's all
We're
this
leaving
about
that in.
having fun on business trips?
Yeah.
One thing I'd say about that is one of the areas where, you know, mortgage advisors, brokers, they have to assess your affordability from a monthly take-home perspective, and they will do a budget plan based on what your like previous sort of habit, like behavior, like financial behaviors are. Like, how much do you spend on food? How much do you spend on, everything? But what I would, so another thing is, if you start saying, I only spend £100 on food in a month, lenders are going to be like, well, you don't. So they'll just take the average, right? So you'll never end up in a situation, or I'd hope you'd end up in a situation where a mortgage advisor would recommend you a mortgage that you couldn't afford to pay, because that's their job.
Yeah.
Ben is a potential first-time buyer and says he's around 18 months from buying. And he wrote in and said, I've seen some people talk about limiting spending before a mortgage application. Is this something that is still relevant?
Yes, it is. I think there's a few myths flying around about spending before you get a mortgage. So lenders will look at your... when you get a mortgage, they'll look at your transaction history. What are you spending money on? What is your typical sort of run rate, again, over time? How much do you spend on things? So limiting spending only matters if it becomes to the point where you're spending too much, where you can't afford your mortgage now. So I would say it's probably not as prominent as you think. And things like spending on gambling.
I was going to ask that.
You know, any weird stuff online that you might do.
Weird stuff. Don't look at me, mate. You're the one who likes toes. Don't look at me.
What are you on about? What a malicious rumour. Likes toes. What does that even mean?
I don't know, mate, but it's believable, isn't
How
it?
did you pull that off the dome?
Yeah, I mean, sure.
He doesn't actually like toes, for the record.
I love them.
Sorry, give me a sec.
No, that's good.
Oh, okay, serious guy.
Yeah. But yeah, my point is, don't stress too much about, you know, if you have a bet now and again, or it doesn't. They're not looking for individual things. They're looking for patterns. They're looking for like, what's your relationship with your money like?
If you're a compulsive gambler that's like all the time.
So if you're at the cash machine at 3 a.m. pulling out
Taking out
500
50
quid,
right?
or you're gambling at like 6 a.m, like, they're gonna regularly, or even like twice, I guess, right? If it shows like irrational,
Well,
like
no, if
unstable.
it's the World Cup and you're betting a lot, like maybe you're gambling on, like maybe it's like the Grand National, or you've had a flutter. But if it's someone who's
regular,
consistently gambling all the time.
But your mortgage advisor will look to see if you can afford it, right? So they will look at their job is to look at your transaction history and say, like, what are you spending? What's an actual acceptable monthly budget for you? So as long as if you're passing that, it's very unlikely, but it can happen, that a lender's going to say, actually, you're not creditworthy because, you know, you've done too many gambling transactions. It has to be a clear problem, I would say, rather than, oh, you've had a bet, or the World Cup's on.
Yeah, I think the good thing about a mortgage advisor is they're basically preparing you for all that. So if you're a bit worried about certain kind of things and you speak to a mortgage advisor, you're not getting put in front of the court and kicked out. They will probably say at that point, look, I don't think this is going to fly, right?
Exactly.
That's their job.
That's their job. They're not going to recommend a product that you can't get.
Yeah, they'll say to you, I think you will get a mortgage, or like high levels of certainty. So just speak to an advisor, I think. And you don't mind people coming to you 2 years out, 18 months out. That's okay.
No, because that's the only, because it's also, you need that for your benchmark affordability as well. Like, how do you know what you can buy right now? Like, if you go online and say, how much can I afford? And you use a calculator that times your income by 4, income 50,000. That's not how income works. Your income's complex. How often do you earn it? Are you self-employed? Is it 2 of you? Is it 1 person? Do you have any dependents?
When's the best time to come to you guys then? Like 2 years, 18 months before you're thinking about buying, or?
To be honest, you can come to us whenever you want. But obviously, shameless plug, we are the only place that you can find out your affordability online without actually having to speak to your advisor. So come to us whenever. 3 years out, 5 years out, if you just want to understand mortgages a bit more, that's what we're all about. We're all about helping first-time buyers prepare for their home. So all the way from 5 years away to you're going to make an offer on the property.
I'll call you this afternoon and be like, what about them 50% houses?
What about them toes? Can we get a link to that?
Of course.
Thing that you do you check your affordability on, because I'm sure people will ask that, so we'll fire that in the notes or whatever.
For Ben and other first-time buyers, what are some of the biggest mistakes people make?
I think they don't understand their affordability early enough. So they end up in this sort of paralyzed state of not thinking they can afford to buy a home. My first suggestion is just figure out what you can afford right now. So that's one of the first mistakes. The second mistake, I would say, just be careful on the credit side. It's great to have credit and to pay off whether you've got loans, payday loans, etc. It is fine to do that, but if you miss a payment, it could potentially ruin your mortgage chances completely. Potentially. So there are some, not forever, but there are some circumstances where you should definitely be careful from an adverse credit perspective. And then third, unsurprisingly, is they go direct to their lender to get their mortgage. Like that's like why would you compare one product? They obviously have a really strong relationship with their bank, so I completely understand why. But your bank's mortgage advisor can only recommend their mortgage products. So my advice is to get a comparison of the market. Go to a broker that's whole of market, compares all the lenders, gets you the cheapest rate, the best deal for you. Yes, that's probably the three things I would say.
Where should people start looking at when they're trying to save?
Where should people, as in what should they do?
What should they do? Yeah.
Yeah, sure. So my first advice is, so first of all, if you're looking to buy property under 400,000, 450,000, lifetime ISA is where I would start. I love the lifetime ISA.
My favorite investment vehicle of all time. It's the GOAT.
It's free money from the government. How often does that happen? Right? So you can get a cash lifetime ISA, or you can get stocks and shares lifetime ISAs. I would say most often, I think 85 to 90% of lifetime ISAs are cash.
Really?
Yeah, because the last thing you want to do is it depends on your house buying horizon. If you're going to buy in the next year or two, I would probably advise cash, so you don't see any stock market changes, because you put like £10,000 in and all of a sudden it goes to 7,000 because the stock market's dropped. But over time, if you're doing 5, 6, 7 year horizon, then maybe stocks and shares lifetime ISA. So yeah, number one is lifetime ISA. Like that's where I would start saving. You can do it either regularly with like a direct debit or a one-off payment.
Just for the audience, you put in 4,000 maximum a year, and the government gives you 1,000 free cash.
Yeah,
and you and a partner can do that, and you can kind of join up. So you can get 2K a year.
Yeah.
What about the fact that there's rumours that they're going to scrap it? How do people look at that?
Yeah, so they're not going to. So they're going to change it for sure. And there's some good things and some bad things coming, I would say. So one of the downsides of the current lifetime ISA is the withdrawal penalty. And it's actually punitive, so you can actually end up getting less than you put in. And the reason they do that is to fund the bonuses, right? So they're going to get rid of the withdrawal penalty. We think. I should caveat that with this. They haven't fully confirmed it. They've said in 2028 we're going to launch a new lifetime ISA. We're looking at getting rid of the withdrawal penalty. We're looking at changing the way that you get your bonus. So at the moment, you get your bonus paid immediately after you deposit, the month after. They're looking at changing that.
So no compounding bonus?
Correct. They're looking at changing it so you get your bonus when you buy your house. Controversially, I'm going to say that's fine. Because controversial, right?
Yes, I'm not a fan of that.
So sure, it's definitely a negative, but one of the downsides of the lifetime ISA is they're giving away too much money to people that aren't actually using it to buy a home. So they're like, how do we make the lifetime ISA? We scrap the retirement bit because you can use it for retirement as well.
That's what I love about it. So I think when you get to 50, was it 60?
What you
60.
60, you can take it out.
You can take it out 60,
even if you don't buy a property, you can still take it out.
And you've got to open it before you're 40 though.
Yeah.
So the lifetime ISA. So controversially, they're getting rid of the. They're changing that, but I think when you look at it, they've got to find a way to make it. Lifetime ISA has to be for first-time buyers, right? If that's the product, having a dual purpose with retirement is why we're kind of in this mess of we're trying to try and claw back some of that money by people that withdraw for the wrong reason, don't get the full money back. Surely it's better that we don't punish people that end up not buying their house and we let them withdraw it without penalty, and then make sure that when a first-time buyer is using it to buy a house, that we pay them the bonus at that point. Because that's the reason we've kind of seen the trade-off.
If you think it, I see it as a retirement product. I don't see it as a house buying product.
Me too.
I know it is a house buying product. So that's why most people use it. But I also think for the self-employed, it's a very attractive pension.
Brilliant.
Very attractive for self-employed.
I'm not saying it's a bad. I think it's brilliant for retirement. In fact, it's actually the second best, isn't it? After pension, it's the second best. It's number 2.
And for certain people at certain tax brackets, it's better than a pension potentially, because do you know what I mean? And for the self-employed, their constant fear is, oh God, I might need the money. So even though it's got a penalty, it kind of just alleviates that my cash flows might drop and I might need the money thing.
Yeah.
So if they eliminate that, I think they're going to see a drop in self-employed retirement savings, which is the complete opposite of what we want.
Yeah. I just think we'll then bring out a
self-employed retirement pension that's a bit more flexible.
Just a better version of that. Like lifetime ISA, the dual purpose aspect of it is why first-time buyers are getting punished, and why there's a higher withdrawal penalty, and why there's this silly cap. Like, why is there a cap on house prices?
Yeah,
it's absolutely mental. Like I think it's 7 to 9 years. I should know this, when the lifetime ISA was launched, and house prices have increased since then? 40% maybe. Like, how can you not change the cap? It's just crazy.
Why have you got to wait till 2028 to do it?
Why have you got to wait till 2028?
Why don't they just increase the cap now?
Yeah.
So it will change for all lifetime ISAs, not just new ones.
Well,
so the existing ones.
I think it's very much we are going to change things. It'll be in a few years. Exactly. It could all get kicked down the road.
Exactly.
We might have an election near then. Yeah. You know what I mean? Like I think it's very up in the air, mate. I do think like it's really sad for people that are trapped in them at the minute that want to buy in, say, London, that just can't,
agree.
and they just face the reality of if they rip the money out, they lose.
That's our number one thing that we get told by our customers. Why can't I withdraw the money that I put in?
Why can't this Labour government understand that if they'd make some quick wins, they'd be a little bit more popular?
Yep.
Do you know what I mean?
It's
Put
true.
the internet on the trains and just up that on the lifetime ISAs from 450 to 750.
Everyone will be happy.
It's worth clarifying that they have said that. You said about changing or new one. They have said that you can still, don't worry about, I don't want to give lifetime ISA savers anxiety by saying they're going to change it. They've said that the current one is still going to be valid. They're not going to make it invalid or change it into a product that's undesirable. They'll honour the existing lifetime ISA product as well as the new one.
Okay.
Awesome. Good news.
I want to know, so Jez Persito. What a legend.
Is that his name? Jez Persito. That's a great name.
J-E-Z Persito. This is how he said, I want to know if anything is going to replace the LISA. So hopefully we've answered that question. It looks
that
more
can
like
be used
tweaks
towards a property over 450K.
Yeah, it looks more like tweaks from 2028. But again, that's a long time away for someone that's sat in, that's got all their money in there, isn't it? Mm-hmm. We got a last question to finish, and thank you for being so generous with your time. We do appreciate it. From Aaron. I'm sorry, but Jez Persito has got the name of the day.
He says, maybe a stupid question, but we have no stupid questions on the Making Money podcast. That's why I'm here. Maybe a stupid question.
Let him say it.
Maybe a stupid question, but I only have a credit limit of £2,000. Does this affect mortgage applications? Do I need to increase my credit limit and keep low utilization?
Wow. I'm impressed at the depth of the question there. So do you need to increase your credit limit? No. Does having a larger credit limit with low utilization over time mean you've got to bet you're more creditworthy from a lender's perspective? Yes. but it's not having a £2,000 credit limit with either low or medium utilization, even max. That's not going to stop you getting a mortgage. So it's not, you don't have to stress about like your credit limit and maximizing it. They will, as I can't remember their name, but they've pointed out utilization is important. So what that means is how much of your credit limit are you actually using every month? Are you clearing off your debt and it goes to zero, or are you maintaining the max balance? That would be not a red flag, but they'd be like, why can this customer not, pay off their debt every month? What's happening there? So when you get a credit score online, if you've got a large credit limit with low utilization, that is the perfect, all the way from like low credit limit, max utilization. That's probably the worst part.
And what if you're like me and you have zero credit limit? Like I don't have no credit cards, no debt. Apart from my student loan, I don't trust credit cards. So I pay for everything. I pay for my car.
Is
that a bit shaky?
It's a bit of a problem because how do the lenders know you're creditworthy?
You can just look at my track record of paying rent on time.
Which they will,
yeah.
By the way, with the track record mortgage, or any mortgage. But you're going to want some level of credit.
Yeah.
My advice.
Phone contract?
Yeah. Phone contracts count.
Utility bills?
Utility, yeah.
Okay.
So you're getting
So it doesn't have to be a credit card. It can just be
correct
regular payments that you...
Basically, can a lender find you in the credit bureau database of proving that can you pay off your debts?
I tried to get a car on finance. They're like, we can't find you anywhere. Are you sure you're a real person? I'm like, I don't have any credit anywhere. So I had to pay for it all.
I mean, I wouldn't advise people to start opening credit cards, especially if the temptation's there to spend money on it. But if you're very self-controlled, open a credit card with a low credit limit and don't use it. That would be better than not having one.
Yeah, I do think as well, though. So, true story. I recently booked a holiday, put a load of money on a credit card because I wanted the protections and stuff. And then a house came up and I was like, I want to live in this house, so we're going to buy it. And I was nervous because I was gone to a mortgage advisor like literally 5 days ago. I've just maxed out my credit card. And he just looked at me and was like, it's fine.
Yeah.
It's no issue.
It's fine.
So the mortgage lender will have seen that I spent like thousands in a day and they weren't bothered. So I wouldn't sit at home and think, oh no, it's a disaster. Again, speak to the mortgage advisor. Agreed. And it's not, you might be in a better position than you think.
Missed payments or defaults or county court judgments, bankruptcy, debt management plans, they're all more serious sort of adverse credit flags that a lender will look at. So if you fall into one of those categories, mortgage advisor is definitely required, I would say. If you've got mispayments, a few mispayments, CCJs that you've been active, or maybe they're even like satisfied, debt management plans you've had in the past. If you've been bankrupt, even if you've been bankrupt, you can still get a mortgage. It's just really hard. Yeah. Cool.
Awesome. Cool. Are we good?
Is that a good place to end on bankruptcy?
Yeah. Okay, Tremaine, what do you think about that one?
Feeling very positive, very charged up. I was a little bit stressed about buying my first property, but for self-employed people, there was options. I like that he gave us loads of practical tips. Double owner, sole proprietor sounds quite interesting, if I can say it. I like it when we give good news, and I'm feeling a lot more positive.
Some good products, really. I thought mortgages had kind of been completed, but there was some stuff in there that I'd not heard of, like the putting the loan in the bank account and then you still get access to it. That sounded quite interesting. If you want to, we spoke about some links in that, didn't we? So we'll link those wherever you get the links. So if you're listening on audio or are watching us on video, hello to the people watching us on video. The people on audio can listen to you breathe.
The people on video can see this awesome outfit I've got on.
He's butt naked. No, you're wearing like a blue suit. No, a blue Nigerian suit.
Blue Nigerian for my tailor.
Yeah, what would they call that suit?
Traditional wear.
Has it not got a proper name?
Probably.
Umboyo or something like that.
That means white man.
Yeah, it does. I remember, mate. I remember. Anyway, sorry. We'll link all of the stuff in the linky place that you need. And if you are watching on video and you're not done with mortgages and you want some more content, watch this video right here. To everybody else, we'll see you later.
Peace.
We won't see you because you're listening. We're not very good at this, are we?
We do what we can. Is that my breathing?
Yeah.
Like Darth Vader. Got big lungs, mate.
Yeah.